The Subcommittee on Government Operations will come to order without objection. The Chair is authorized to declare a recess at any time. The gentleman from Virginia is on his way, and so we're going to go ahead and try to get this started in the interest of your time and some pressing schedules that are here. I'd like to start off by acknowledging just the incredible work of the staff, both in majority and minority, on their preparation for this particular hearing. It's an issue that obviously has great impact, but it's also one that was not on my bucket list. And so it's been interesting to be able to come up to speed on that and be aware of it. And as you know, the federal long-term care insurance program helps federal employees prepare for the future health care needs by enrolling in long-term care insurance coverage. Federal employees can help reduce the financial burden of acquiring care as they grow older. And these burdens obviously can be very costly. According to the Department of Health and Human Services, Americans turning 65 today will spend an average of $138,000 in long-term care services. By purchasing insurance now, the federal employees can start paying for those services that they will need well into the future. Alarmingly, the cost for this insurance continues to rise. And on July 18th, the Office of Personnel Management, better known as OPM, after signing a new contract with John Hancock Insurance to administer the program, announced that the premium rates for most enrollees will drastically increase. Premiums have increased an average of $111, representing an 83% increase for nearly all of the 274,000 program enrollees. For 102,000 of these enrollees, the rate increase was between 100 and 126%, translating to about $200 per month extra that people must pay to maintain the coverage. These most recent premium increases come after rates have already increased in 2009 by nearly 25%. And for many enrollees, including some 7,500 North Carolinians who are part of this program, this cost increase has been a financial difficulty. Unfortunately, these rates, the rate increases are not limited just to the federal program. Premiums have increased for nearly all long-term care insurance programs in the private sector as well, as my mother has very eloquently illuminated to me. And so a large reason behind these premium increases have to do with the nature of long-term care insurance. Insurance carriers must project a host of variables, including mortality rates, voluntary lapses, interest rates, morbidity rates, and the like. The values of these variables are constantly changing, and when projected several years into the future, it makes for the actuarial assumptions to be difficult, if not off, in a number of cases. This necessitates premium increases at times in order for the insurance carriers to guarantee it can cover the expected benefits. Fortunately, insurance carriers have begun to acquire actual claim data in order to make more informed assumptions. The hearing today will provide this committee the opportunity to delve into the variables that actually must be taken into account when setting these premium rates. This hearing will also allow the committee to look at factors affecting the lack of competition for federal programs contracts. I'm concerned only that one carrier has bid on this contract, both the second and third contracts. Encouraging healthy competition for federal long-term care insurance programs contracts is an important aspect. And so I look forward to hearing all of your testimony that we will receive today. And I recognize the gentleman from Virginia, my good friend, the ranking member, Mr. Conley, for his opening statements.
Thank you, Mr. Chairman. And thank you for the honorable way in which you've responded to my request to have this hearing. I really appreciate it. And you've kept your word in helping make sure we had a hearing on this very important topic. I also ask unanimous consent to enter a statement into the record from Anthony Reardon, the National President of the National Treasurer Employees Union.
Without objection.
I thank the Chair. The Federal Long-Term Care Insurance Program, also known as FELTSIP, was created in 2002 to provide affordable long-term care insurance to Federal workers and their families. The program has been administered by John Hancock Life and Health Insurance Company and overseen by the Office of Personnel Management. Although the Federal Government provides benefits to Federal employees, it is paid for by Federal employees with no government contribution. This past July, OPM announced rate increases in the program that affected nearly all of the 274,000 FELTSIP enrollees. Like many of my constituents, I was shocked to learn that the increases averaged 83%, equivalent to an additional $111 per month beyond the current premium that enrollees were paying, and nearly 40% of enrollees were actually subject to 126%. OPM has an obligation, it seems to me, to the Federal employees enrolled in the program to provide a service that's affordable. OPM's management and John Hancock's administration of the contract has left many FELTSIP enrollees scrambling to find ways to find affordable alternatives or to pay for the increasing costs of long-term care through other methods, and that raises serious concerns. Many of my constituents are worried about how they will afford to pay increased premiums. Many are retirees on fixed income, and a huge increase which they did not expect and did not plan for is putting them in a financially untenable position. Although Hancock provided enrollees with a few personalized rate options, the choices are less than satisfying to most of my constituents. If enrollees choose to keep their existing long-term care coverage, they somehow have to find the way to get the additional money to pay for it. If they cannot afford to pay the increased premium, then they have to reduce their coverage to lower the cost or give it up entirely. Those are not particularly desirable options. It's important to note that this was not the first rate increase since FELTSIP's inception. In 2009, after Hancock was awarded the FELTSIP second contract, 66% of enrollees were notified their premiums would increase by up to 25%. Prompted by the alarming increases in FELTSIP premiums in October of 2009, the Senate Permanent Select Committee on Aging held a hearing to examine FELTSIP and long-term care insurance in general. Witnesses from OPM and Hancock at that time agreed that the misleading language used in marketing materials led enrollees to believe they would not suffer any, much less egregious, increases in premiums. The series of dramatic rate increases over the last two contract terms are propelling FELTSIP premium prices out of reach for the average middle-class Federal employee. When FELTSIP was established by the Long-Term Care Security Act, it was intended to be an affordable way for individuals to protect against the risk of losing all of their retirement savings because of a long-term illness. It was meant to provide a safety net for Federal employees in old age. During an April 1999 Oversight Subcommittee hearing, then Representative Joe Scarborough, now a television host, the lead sponsor of the bill, a Republican, stated that he hoped to make long-term care, quote, affordable and available to all Federal employees. Maybe we should have subpoenaed him, Mr. Chairman. Today we have a product that has become unaffordable for most Federal workers. It's clearly deviated from the intent of the Act. However, Federal workers are not alone here. Industry experts are saying that all middle-class Americans are struggling with the same problem. Rate increases and benefit reductions are happening in the private sector, too, when it comes to long-term care. And nearly all private sector companies have abandoned unlimited long-term care coverage, leaving no long-term care insurance option for those who want to guard against the risk of catastrophic long-term care costs. I'm concerned about the future of this important kind of insurance, as I know you are, Mr. Chairman. Long-term care insurance was designed to close gaps in coverage. Long-term care costs are not covered by Medicare or health insurance, and Medicaid only covers such costs for low-income individuals. With over 70% of people age 65 and over needing some long-term care during their lives, and costs of semi-private nursing homes averaging well above $100,000 annually, the necessity of this insurance seems clear. John Hancock, one of the few remaining and largest long-term care providers in the United States, serving 1.2 million enrollees, has recently announced it will be pulling out of the private sector long-term care market, as I understand it. As options for long-term care dwindle, many individuals rely on their families to provide care. However, family caregivers are becoming scarcer as baby boomers will outnumber caregivers 4-to-1 by 2030. 2030, this baby boomer will be over 70. This hearing not only provides an opportunity to look at ways to ensure that FELDSIP lives up to its original promise, but also to understand the reasons for the rate increases so we can try to work together to find solutions to address the failing market. This problem affects hundreds of thousands of Federal employees and retirees and millions of middle-class Americans. The market has not solved this problem on its own, and today's hearing cannot be the last on the topic. Historically, Republicans and Democrats have agreed that when the market is unable to solve a problem, the government has an appropriate role to play in finding solutions that work for American families. I feel strongly that this market failure and the exposure of many Americans to catastrophic costs deserves our attention. We've got to safeguard about affordability and stability of long-term care premium rates for middle-class Federal workers and, indeed, for all Americans. I thank all of the witnesses for being here, and again, thank you, Mr. Chairman, for delivering on your promise.
I thank the gentleman for his eloquent words. I also would note that we will hold the record open for 5 legislative days for any member that would like to submit a written statement. The Chair notes the presence of the gentlewoman from Virginia, Ms. Comstock, is here. It is my understanding that the gentleman from Virginia, Mr. Byers, and the gentleman from Maryland, Mr. Delaney, may indeed come as well. We appreciate, Ms. Comstock, your interest in this topic.
Mr. Chairman?
Yes.
I would ask unanimous consent that all of those named be given the privilege of participating as if they were members.
Without objection, so ordered. I'll also ask unanimous consent to enter into the record a statement from the representative from Maryland, Chris Van Hollen, on this particular subject. Without objection, so ordered. We'll now recognize our panel of witnesses. I'm pleased to welcome Mr. Michael Dowdy, President and General Manager of John Hancock Insurance. Welcome. Mr. John O'Brien, Senior Advisor for Health Policy at the U.S. Office of Personnel Management. Welcome, Mr. O'Brien. Ms. Laurel Kastrup, Chair of the Health Financial Reporting and Solvency Committee at the American Academies of Actuaries. Thank you for being here. Mr. Richard Thisson, National President of the National Active and Retired Federal Employees Association. Welcome. And Mr. Mark Cohen, Clinical Professor of Gerontology at the University of Massachusetts, Boston. Welcome to you all, and pursuant to committee rules, all witnesses will be sworn in before they testify, so if you would please rise and raise your right hand. Do you solemnly swear or affirm that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth? Let the record reflect the witness's answer in the affirmative. You may take your seat. In order to allow time for discussion, we would ask that you would limit your oral testimony to 5 minutes. Your entire written statement, however, will be made part of the record. And so I'd like to go ahead and recognize you, Mr. Dowdy, for 5 minutes.
Thank you, Chairman Meadows, Ranking Member Connolly, and members of the subcommittee. I'm Mike Dowdy, President and General Manager of John Hancock Insurance. I oversee John Hancock Insurance products, including the Federal Long-Term Care Program. I appreciate the opportunity to be here today to discuss the Federal Long-Term Care Insurance Program and the contract that OPM awarded to John Hancock Life and Health Insurance Company in April 2016. John Hancock has been involved with the program since its inception, and we remain committed to providing a strong and financially sound long-term care insurance product for Federal employees. We recognize enrollees' legitimate concerns about the premium increase and the very real impact that it will have on people's lives. I appreciate the opportunity to address that increase, the reasons that it was necessary, and the steps that John Hancock has taken in coordination with OPM to provide enrollees with alternative options designed to mitigate the financial burden of the rate increase. Congress created the Federal Long-Term Care Insurance Program 16 years ago. Under the authorizing legislation, OPM conducts a competitive bidding process and awards a 7-year contract to a company to provide long-term care insurance. Regardless of the company that received the contract, the legislation has a unique feature that requires all funds, premiums and investment returns, to be maintained separately in a fund called the Experience Fund. The Experience Fund is used exclusively for the program's assets and liabilities, and it transfers to a new carrier if OPM awards the contract to another provider. Also, the Experience Fund receives no taxpayer money. All benefits are paid by the enrollee's premiums and the fund's investment returns. For these reasons, it is critically important that the premiums and the projected investment returns of the Experience Fund match the projected claims that enrollees will make many decades into the future. The entire industry has learned that making predictions about claims in the far distant future is very challenging. But it was these projections that made the recent premium increase necessary. In 2013, John Hancock observed trends in our non-federal long-term care insurance policies that we determined could affect the federal program. So we began an assessment of the federal program. The review of the federal program, which was completed in May 2014, showed that the Experience Fund would experience a deficit in the future. We found that new claims were increasing, particularly at older ages. Claims were lasting longer than expected, and policies with higher daily benefits had higher than expected claims. We continue to evaluate the data. Overall, the data revealed changes in mortality rates. People are living longer than previously expected. Morbidity rates. More people are requiring long-term care and for longer periods of time. And investment changes. We've been in a sustained period of low interest rates. On page 7 of my written testimony, there is a chart that captures the effects of these changes. The Experience Fund was projected to enter a deficit between 2035 and 2040 without a premium change. With the premium change, the fund is projected to maintain funding sufficient to cover all enrollees' projected future claims. Both John Hancock and OPM have a contractual obligation to adjust the premiums to make sure that the Experience Fund is able to meet the needs of enrollees for many decades into the future, and that's what we did. Importantly, these projections were reviewed by John Hancock's experts, by OPM, by John Hancock's independent actuarial firm, and by OPM's independent actuarial firm. Next, recognizing the significance of the premium change, John Hancock worked closely with OPM on the implementation. First, we created a program to communicate with enrollees about the premium increase, including a website, webinars, videos, FAQs, and a professionally staffed call center. Second, we created several alternative options which were designed to permit enrollees to adjust their coverage in light of the premium increase. Finally, Mr. Chairman, I want to note that John Hancock agreed in our new contract with OPM to reduce the charges that we receive under the contract so that John Hancock will not have an increased profit from this rate increase. Thank you for the opportunity to be here today. I look forward to discussing possible ways to strengthen the federal long-term care insurance program, and I would welcome the opportunity to answer your questions.
I thank the gentleman, and I recognize Mr. O'Brien for your 5 minutes of testimony.
Thank you. Vice Chairman Walberg, Ranking Member Connolly, members of the subcommittee. Thank you for the opportunity to testify on the Federal Long-Term Care Insurance Program. OPM's mission is to recruit, retain, and honor a world-class federal workforce to serve the American people. Part of that mission requires OPM to administer benefits, including the insurance products such as the Federal Long-Term Care Insurance Program, for federal employees, annuitants, and their families. At the outset, let me make clear that I share the committee's frustration that premiums needed to be raised by such a significant amount. I and my colleagues at OPM are painfully aware of the financial burden and hard choices those premium increase placed on participants. However, we cannot avoid our primary responsibility to those participants, to assure that when the time comes for someone to use the benefit that they have paid for, the funds will be there to deliver those services. The Federal Long-Term Care Insurance Program currently serves roughly 270,000 members whose premiums cover 100% of program's costs. All those premiums and the income those premiums generate is held in a single experience fund by John Hancock. While the fund is held by John Hancock, it belongs to the program and not the insurer. The Federal Long-Term Care Insurance Program must assure that it can provide benefits decades into the future. Therefore, premiums must be based on long-term projection of both costs and revenues. We are here today because at the end of the most recent contract cycle, the long-term insurance program had to respond to two hard facts. First, estimates of long-term care costs are increasing, and second, projections of long-term revenues to support those costs are decreasing. The confluence of higher anticipated costs and lower anticipated returns is not unique to the Federal Long-Term Care Insurance Program. The entire long-term care insurance market faces this challenge. Given these circumstances, increased premiums were necessary for the long-term viability of the Experience Fund. Without the increase, there would be an unacceptable risk that the Experience Fund would not have sufficient funds to pay for future claims. In order to test the market and ensure that the reasonable efforts were made to attract the most competitive proposal, OPM made the decision to recompete the contract. John Hancock was the sole bidder, and OPM awarded the contract in April 2016. The premium rates proposed by John Hancock were reviewed by OPM staff and its actuaries. In addition, OPM contracted with a separate, independent actuary to evaluate the proposed premium rates and confirm the reasonableness of the assumptions used. While the long-term viability of the Experience Fund made a substantial rate increase necessary, OPM was well aware of the economic hardship that the rate increase would cause participants. OPM's priority became to do all it could to assure that enrollees had the information and opportunity to make informed choices about the costs and benefits of coverage in light of their own circumstances and needs. Working with John Hancock and long-term care partners, we conducted an enrollee decision period from July the 18th to September 30th. Outreach efforts included 3 direct mailings to enrollees with personalized information about the rate increase and options that they could use to adjust their benefit package to reduce their premium or keep the same premium, a website also with personalized information, as well as a set of informational videos that explain benefit options. And finally, a fully staffed call center that assured individuals could get their questions answered by a real person. In large part, the enrollees took advantage of this enrollee decision period. By the end of October, 172,000 enrollees, or just shy of 2/3 of the entire population, took some action in response to the premium changes. Of those who took action, most chose to keep their premium constant by reducing their benefit package. While OPM remains committed to the FLTCIP program and the individuals it serves, we must also acknowledge that the long-term care insurance marketplace has changed substantially from 2002 when the program started. At that time, over 100 insurers offered long-term care products. Today, only a handful of insurers are actively selling long-term care insurance, and those insurers are primarily serving individuals via individual policies rather than group plans. The challenge of matching premiums with long-term costs and revenues is real and ongoing. OPM staff is and will continue to closely monitor these trends and what it means for the long-term care insurance program, and work to ensure that participants have an array of options to meet their needs. Thank you for the opportunity to testify today, and I am happy to address any questions you may have.
I thank the gentleman. I recognize now Ms. Kastrup for your 5 minutes of testimony.
Vice Chair Walberg, Ranking Member Connolly, and distinguished members of the subcommittee, thank you for the opportunity to testify on the issue of examining premium increases for long-term care insurance. My name is Laurel Kastrup. I am an actuary specializing in long-term care insurance and financing. I am representing the American Academy of Actuaries. The Academy is a nonpartisan professional association representing the actuarial profession. Our mission is to serve the public and the U.S. actuarial profession. We do this by providing independent and objective actuarial information, analysis, and education to help in the formation of sound public policy. I would like to start by emphasizing the importance of actuarial input when considering the design and evaluation of any potential long-term care policy approach. Actuaries are uniquely qualified according to our professional standards. Qualified long-term care actuaries play a crucial role in the design of long-term care financing systems, from private long-term care insurance to public programs that provide long-term care benefits. Actuaries have specialized expertise in managing the risk of adverse selection in insurance coverage. We have the ability to recognize and incorporate uncertainty into cost projections and premiums. We also have experience in evaluating the long-term solvency and sustainability of public and private insurance programs. The Academy recently developed an issue brief to highlight important underlying factors affecting long-term care insurance premium rate increases. Without long-term care insurance, many more people would exhaust their savings on care costs and then potentially rely on public programs such as Medicaid for their additional care needs. Long-term care insurance requires a long projection period, with assumptions extending over 50 years into the future, which creates a high level of uncertainty. The premium rates needed to ultimately be sufficient are also affected by changing circumstances, such as changing service providers, for example, the growth of assisted living facilities, changes in incidence of Alzheimer's disease, the effects of mortality improvement in the population, and changes in family composition, reducing availability of caregivers. Determining premium increases is a relatively straightforward mathematical calculation. However, determining projection assumptions can be difficult. Actual historical experience that is sufficiently credible is needed to justify the future assumptions used in projections. With long-term care insurance, it can take a long time from the purchase of a policy until the first time a claim is submitted. This means that for a relatively young group of policy forms, there is often little claims experience to justify premium rate increases based on those forms alone. Actuaries are required by actuarial standards of practice to use alternative data sources, such as experience from the insurance company's older, similar policy forms, or public data for identifying reasonable assumptions. Waiting until there is adequate claim information on each policy form could result in much larger, less affordable rate increases. Insurers have routinely allowed insureds to reduce coverage by changing benefit options in order to help offset some or all of a rate increase. In an effort to enable policyholders faced with a rate increase to retain significant coverage, some companies have started making available an option for policyholders to avoid the rate increase by reducing their future automatic built-in inflation increases. In closing, I want to mention that I understand that these premium rate increases can affect families. My own personal experience with long-term care insurance was that my grandpa had a policy. It had a small daily benefit. He gave up the inflation option to avoid rate increases. When he moved into an assisted living facility, his long-term care insurance policy, along with his income from Social Security, was enough to make the cost affordable for him. Predicting future policyholder and service provider types and availability can be difficult. This uncertain future makes it important that there is a way to take corrective action. The more conservative assumptions used in today's pricing of private long-term care insurance and the improved speed at taking corrective action should improve future projections, resulting in fewer and smaller rate increases. I again thank you for the opportunity to be here today with you and share the recent analysis by the American Academy of Actuaries on long-term care insurance. I would be happy to answer any questions.
Thank you, Ms. Kastrup. And now I recognize Mr. Thyssen for your 5 minutes of testimony.
Good afternoon, and thank you for the opportunity to express NARF's view on premium increases for enrollees in the Federal Long-Term Care Insurance Program, or FLTCIP. NARF was proud to have played the lead role in supporting legislation creating FLTCIP, but we are extremely disappointed in the recent premium increases. FLTCIP premiums increased by an astounding 83% on average and by as much as 126% for nearly 40% of the enrollees. The average increase amounts to $111 per month. For many, the increase will be much larger. These cost increases come as a rude awakening for enrollees. Following the announcement in July, they were presented with difficult and unfair choices: pay substantially higher premiums, reduce coverage significantly, or abandon what for some had become more than decade-long investment in protecting their future. This situation should not have occurred and signals the need for changes in the program. We have heard from hundreds of NARF members, and their messages have been personal and blunt. One NARF member reported her premiums would rise from $275 to more than $600 per month. She is not alone in her experience. Another member told me, "I am so much older now than when I entered the federal plan. The cost to switch to another plan would be prohibitive. All my bills are fixed. The new payment will have to come from the grocery budget." Another said, "We have already paid John Hancock $56,000 in premiums. We cannot quit now. We have too much invested. We are outraged by this bait-and-switch scheme." End quote. For these enrollees, the reasons behind the increases come as little comfort, but are worth examining. The actuaries got it wrong. Long-term care costs are rising faster than expected, and interest rates are expected to remain low. This may be the case, but the actuaries and the insurance company did not just get it wrong, they got it very wrong. We hope this hearing, at the very least, provides the opportunity to further investigate why the assumptions were so far off and how lessons learned from those mistakes may be applied to assumptions about the future. But our efforts should not end there. We need to plan for long-term care. The need to plan for long-term care is as much a reality today as it was when the program was created 16 years ago. Average long-term care costs are high: $3,800 per month for home health, $3,600 to stay in an assisted living facility, $7,700 for a private room in a nursing home. 69% of Americans will need some long-term care services for an average of 3 years. Without adequate insurance, too many will be bankrupt and forced to rely on Medicaid. Federal employees and retirees want to do the responsible thing for themselves and their family. This program seeks to address the real need to plan for these future long-term care costs, but the lack of price stability and affordability make it increasingly difficult to do so. Legislative reforms are needed. NARF proposed a number of policy options in my written testimony. One of these proposals including providing enrollees an option to convert their plans to hybrid long-term care / life insurance policies, which would provide price stability. Another is to provide options to extend waiting periods or buy plans with deductibles, which would improve affordability. NARF also supports broader reforms to national long-term care policy. The crisis faced by FELTSIP is not unique. Individuals in private long-term care insurance plans are facing significant premium increases, and neither FELTSIP nor any other private long-term care insurance provider is continuing to offer unlimited catastrophic coverage. Middle-class consumers seeking to insure against the worst-case scenarios are left with no options at all. Rather, Medicaid, a program intended for to protect those in poverty, steps in as the only catastrophic option for consumers, who must bankrupt themselves in order to qualify. Instead, NARF supports a public-private partnership with universal catastrophic insurance program that covers costs between the first 2 or 3 years of care, and private insurance, such as FELTSIP, to cover the front-end costs of care. It is incumbent upon this subcommittee to support real reforms that provide Americans with affordable, reliable options. Enrollees should not bear the risk when insurance companies and actuaries make mistakes, and they should have options available to plan for their future needs. NARF looks forward to working with Congress to pursue them. The status quo is unacceptable. Thank you so much.
Thank you for your testimony. Now I recognize Mr. Cohen for your 5 minutes of testimony.
Thank you, Vice Chair Walberg, Ranking Member Connolly, and members of the subcommittee. I'm Mark Cohen, the Director of the Center for Long-Term Services and Supports at the McCormick Graduate School at UMass Boston, and a former President and current advisor to Life Plans, Inc., a long-term care research, consulting, and risk management company. I appreciate the opportunity to testify on this topic, and in my testimony today, I will draw upon my 25 years of research focused on the private insurance market. I'd like to make 3 broad points today. First, the rate increases that we're discussing should be viewed within the broader context of the long-term care insurance market and the challenges faced by all insurers in that market. These rate increases are occurring across almost all blocks of business as actuaries learn how the product is performing and make adjustments to their initial pricing assumptions. Second, the current marketplace challenges do not diminish the need for an insurance-based solution for middle-class Americans, many of whom will face catastrophic costs and financial impoverishment in the absence of insurance solutions. Finally, without public action, the private insurance market alone is unlikely to play a meaningful role in financing the nation's long-term care needs. More specifically, an insurance-based public-private partnership stands the best chance of moving the needle on protecting middle-class Americans from significant costs that threaten their retirement. Let me begin by making a few key observations to frame some of the subsequent discussion. Today, fewer than 10% have insurance protection, industry-wide sales are declining significantly, and many companies have exited the market. Thus, the market is shrinking rather than growing, and this at a time when more Americans are facing significant long-term care costs. There are a number of reasons why so many insurers have stopped offering policies. On the demand side, selling costs are high because consumers lack knowledge and understanding about long-term care risks and costs. They're confused about the role of public programs, and there's general mistrust of insurers. On the supply side, insurers have faced a variety of unpredictable and often uncontrollable risks that are hard to spread. For example, given the current funding structure of almost all standalone policies, companies must correctly estimate yields on investment premiums 20 to 30 years into the future. An error of just a few percentage points in such an estimate can result in very large premium increases to assure adequate funding of future claims. Second, unfolding negative claims experience has led to large rate increases as insurers waited many years before requesting some of these rate increases. Recent research shows that people would prefer smaller but more frequent adjustments rather than large, infrequent ones. The problem is that these premium increases have made the product too costly for a growing number of middle-class consumers who only have personal savings and safety net programs like Medicaid to rely on should they require significant amounts of care. Despite private sector challenges, variation in long-term care needs and expenses make risk pooling through insurance desirable. The underdevelopment and growing unaffordability of private insurance and the absence of any public insurance present a fundamental problem. People have no way to effectively plan for what is a perfectly insurable risk. Since current strategies have not worked well in assuring broad consumer appeal and insurer enthusiasm, what can be done? Some concrete actions include simplifying and standardizing products to reduce selling costs, changing the structure of premiums payments so that there is some level of indexing to address both affordability and premium stability issues. Also, without expanded federal and or state support designed to spur both demand and supply, however, the needle is unlikely to move enough to protect the majority of middle-class Americans. In addition to an educational campaign designed to reduce consumer confusion and increase knowledge and awareness, we need to think more broadly about shared public and private insurance models. For example, given that the private insurance market is not willing to provide products any longer that cover the catastrophic tail risk, one might consider whether and how states or the federal government might do so. Such an approach could provide a base that the private insurance industry could supplement or wrap around, and it would likely encourage more insurers to get back into the market, broaden the risk pool, and lower the cost of insurance products. In the interest of time, I will stop here, but would be happy to answer any questions that the committee might have. Thank you.
Thank you, and I thank the panel for your testimony. And now I recognize the gentleman from Wisconsin, Mr. Grothman, for your time of questioning.
Interesting testimony. I'm going to ask Ms. Kastrup, is that right, a few questions. I don't know if you're familiar with this product as opposed to other products, but whenever there's insurance, I don't know if it's health insurance, car insurance, whatever, you always kind of wonder how much of that premium is going for claims and how much is going for overhead and commissions and that sort of thing. Could you give me some of the insurance industry in general, how much of, say, auto insurance, health insurance, and long-term insurance, how much goes for claims?
I'm not an expert in all of those areas. Very few actuaries would cover all three of those areas. it depends on the pricing structure, and depends on how the product was sold, so it would vary by carrier as well, whether it was
Right.
sold with an agent or not. And so there's not really a guideline I can give on that, but I could research that and come back.
You can give me an about, like, when you pay your auto insurance premium, you're an actuary, you must have some idea.
I'm not a casualty actuary. I don't practice.
Well, okay, well,
car
which type of insurance do you deal with?
with long-term care insurance.
Okay, and do you have long-term care insurance? No, you're too young, right? Do you have long-term?
I myself do not have a policy, no.
Okay. Do you know, guess, if your parents had a policy, how much do you think goes out average in, what percentage of the premium goes out in claims?
Like I said, it would vary by carrier because it depends on how the product is sold and what costs go into it, whether it's a group policy or an individual policy. There's a lot of different factors that go into that. I don't know right offhand, but I could look into it and get back to
You
you.
must have some idea for some policies, don't you? No idea at all.
It would depend on your.
I know it depends, but, they sell these things. Is it 10%? Is it 50%?
I can maybe add something on that.
Sure.
At least historically, when these products have been priced, the idea was that somewhere between 60 to 70% of the dollars that were collected would eventually get paid out in claims,
Okay.
just to get for order of magnitude.
And can you compare that? Are you aware of any other kinds of insurance? Can you compare that to automobile insurance or some other insurance?
I don't know. I will say that, as I mentioned in my testimony, the selling costs associated with long-term care insurance are pretty high because of the lack of information, confusion. It's not a sort of one and done. It's agents sitting across the table from people and so on. And that's one of the ways that we have to think about making the insurance more affordable is how to reduce some of those selling costs. They can represent anywhere from 15 to 25% of the premium.
Okay. You mean for selling costs?
Yes.
Okay. And could you compare that to any other kind of insurance, or you don't know?
Don't know.
I'll give you another question here. Mr. Doherty, you must know, because doesn't John Hancock have other insurance other than just long-term care?
We do offer, the only other kind of insurance we offer is life insurance, which has, in terms of selling costs, et cetera, it's quite similar. In terms of the ongoing administrative costs, because you're paying out, when a client goes on claim, you're just paying out one death benefit, so that would be slightly lower than in long-term care insurance.
Okay. I'll give you another question. I've always wondered about this on long-term care insurance. With any insurance, there's a degree of moral hazard, okay, in that your behavior changes because you're insured. People have to make a decision, families in life, as to whether you're going to allow somebody to go to a home or not. And I think sometimes families do extraordinary things due to the huge cost of long-term care. They can take care of grandpa for years and years because they don't want to kick out whatever, $8,000 a month or something. And therefore, I've always kind of thought that if you have long-term care insurance, maybe people are quicker to send grandma to the home than they would be without insurance. Do you feel there's that degree of moral hazard when people buy long-term care insurance?
Yeah, I believe that is absolutely a reality, that people that don't have coverage are far more likely to take care of mom and dad for longer. I also think in the context of this broader discussion about the future of long-term care, and I think we're all in agreement that we need to do better, that one of the risks of that reliance in the past on families taking care of people is that families are becoming more spread out. There's more divided families. So I think in the future, it's going to continue to pose a problem in terms of overall support for people requiring long-term care.
Can I ask one more
Gentlemen,
quick question?
Time has expired. We'll have to move on.
Okay.
I thank the gentleman. Now I recognize the gentleman from Virginia, the ranking member, Mr. Connolly.
I thank the Chair, and this conversation is why I requested this hearing, and I'm so glad we're having it. But first, just, Mr. Dowdy, are you from Baltimore, Philadelphia, or Canada?
I am from Canada.
Yes. You speak with a diphthong, O-U-T. Okay. So, Mr. Dowdy, Hancock got out of the private sector provision of this kind of coverage. Is that correct?
Yeah, just to be perfectly clear on that front, we recently decided that we were going to stop selling standalone retail long-term care insurance policies.
Right. Why?
Primarily because, while we recognize a growing and increasing need, I think as Dr. Cohen noted, it was becoming increasingly difficult to actually develop enough critical mass in sales to make it a worthwhile business venture.
So it wasn't because people are living too long or getting older. It wasn't even the expense, if I'm hearing you correctly. It was that you just couldn't get to critical mass in terms of making it worthwhile as a marketable product.
Yeah, I think the two are related, though. I mean, we have been for a long time a player in the private long-term care insurance market. We continue to provide service, and
I understand, but I mean, if 50 million customers knocked on your door tomorrow saying, we want this insurance, would that change your posture in terms of providing it?
It would, and primarily because we actually had come up with a new product that we thought provided some rate stability and things like that. So yes, it would have, definitely.
And just, what's the chicken and the egg thing here? Is the reason for the drop in the popularity of the product or the demand for the product because of the pricing? Or is it just, we're just not that interested in long-term care?
I think it's both of those issues. I would say the primary issue, because if you see sales have come down, it's because of the pricing.
Yeah.
I do believe that there's still a reluctance for younger people to think about long-term care.
Got it. So, Dr. Cohen, is this a non-viable product, given what's happening in the market?
I don't.
We cannot hear you.
Won't touch that. Okay.
There you go.
Sorry. No, I don't think that it's. I don't think that it's unviable. I think that there can be changes in the structure of the product. There can be much greater education. To your last question, also, when we look at the primary reason why people who've been approached to buy this insurance don't, it's a cost issue. They don't see the value proposition. And if you don't believe you're at risk, if you believe that public programs are going to cover you, then why would you lay out the money? There's a lot of work that needs to be done in that regard. And I also think that these types of product work best in the context of a broader public role. And that was one of the things I meant.
And real quickly, to get it on the record, because you suggested that in your testimony, is there a precedent for that in terms of the Federal Government getting involved directly in sort of trying to fix holes in the market in the insurance industry?
Sure. I mean, there are the Federal Government has been involved in, for example, organizing risk pools for, flood insurance.
There you go. Flood insurance. Federal footprint is quite considerable, right?
I mean, when there are issues that are, especially when it relates to insurance, if there are common shocks that affect the entire industry, then you can't, you can't spread the risks adequately, no matter what you end up doing.
Right.
And so
I'm only establishing on the record, because I'm anticipating arguments in our next Congress on the subject matter, that this would be an unprecedented role for the Federal Government. Not true. In fact, the Federal Government has been involved in the insurance market in various and sundry ways, including flood insurance especially, which may be a model, not slavishly devoted to that model, but a model.
Right. I mean, on that point, I would like to say that it's likely, there's no magic bullet here. It's a combination of both demand and supply.
We understand. Mr. O'Brien, my final point. So OPM, other than weeping and gnashing its teeth over what's happening to your constituents, my constituents, Federal employees and retirees in terms of cost, has OPM come up with any ideas in terms of how we solve the problem or address the problem? or make it easier for those constituents to avail themselves of this kind of coverage at an affordable price?
Yeah, we do not have any proposals to bring before the committee right now. However, we are very interested and committed to working with anyone on ideas that might work. We appreciated some of the ideas that NARF shared in their testimony, and we look forward to working with people to figure out what we can do moving forward.
Well, that's quite a piece of testimony. Thank you.
I thank the gentleman. I recognize myself for my 5 minutes of questioning. Ms. Kastrup, in your testimony, you indicated that there continues to be a high level of uncertainty in the long-term care market that affects premium rates. Can we ever expect long-term care insurance premiums to stabilize as more claims experience becomes available?
Thank you. I think I also mentioned that it's a long projection period, and any time you have a projection period, like a 50-year projection period, you're always going to add more uncertainty as you spread that out. I do think we have more stability in assumptions than we did in the initial years. Every new bit of experience, more bit of credibility, gives us a better basis to project out. I don't think we'll ever have perfect. We don't have perfect in life insurance, and we've been doing that a lot longer than long-term care insurance.
But is there any reasonable guess when it might stabilize?
Well, one of the issues that makes that hard is that care delivery has changed a lot from the initial policies. If you think about it, the initial policies were sold as nursing home insurance, and the thought being no one wants to go to a nursing home, and, you know, assisted living facilities didn't even exist. Today there's assisted living facilities, there's home care, and the policies cover these as well, even though they were maybe not even around when the policy was written. And so it would be hard to ever foresee future care delivery changes and know those perfectly, but we can get a lot better feel on things like mortality improvement, some of those assumptions.
That could change the prediction, ultimately, of...
Well, there's a lot of assumptions, and some of them we will have more certainty on and know more about. There will always be some things that we won't know.
That's comforting for me to know, having bought long-term care. So, thank you. Mr. Doty, recently John Hancock announced that it was going to discontinue selling new standalone long-term care policies because there's limited demand for the product. Why is there limited demand for the product?
I think the primary reason, I think they've been touched on a little bit today, is one has been this price increases that have happened, and the other has been a general lack of understanding that people need to actually think about this very important event that could happen to them in the future. I will say on that point, however, that when you know, all of the things that we've talked about, both in terms of prices going up in the FLTCIP, but also in standalone retail insurance, the prices are going up because the costs are going up. And so people still have to consider these products in the context of what alternatives do they have. They can stay in that kind of a program, they can try to buy something on the private marketplace, or they can try to fund it themselves. And generally speaking, insurance, although sales have gone way down, insurance still can, for many people, provide a very attractive alternative in that context.
Any other factors specifically for your company go into making the decision?
The decision to stop selling?
Discontinue selling?
No, the primary factor, and really the overwhelming factor was, I mean, there's questions about how long you tie up capital, et cetera, in this kind of a product, but really the number one factor was really just a pretty simple business discussion around, can you sell enough of it to cover the infrastructure you need for your sales teams, for your you know, negotiating with each state, all those kinds of things.
Did you consider what that means for individuals who have purchased standalone policies?
Yes, and I thank you for asking that question, because I want to be very clear on that point. We have not stopped. We continue to be in the long-term care business. We have 1 million customers that we continue to provide service to, pay claims for. We continue to be providing insurance for the federal program, and we also provide long-term care insurance as an accelerated benefit on our life insurance policies, which is an increasingly popular way to for consumers to get their long-term care insurance coverage.
Will there be substantial premium increases for these individuals?
On our, which
On the
individuals?
standalone, those that have purchased it?
Our in-force long-term care insurance has been experiencing really the very same trends that we've been discussing as part of the federal program. Yes.
Okay. Well, thank you for your testimony. I yield back and recognize Mr. Lynch for your 5 minutes of questioning.
Thank you, Mr. Chairman, and thank you and the ranking member for holding this hearing. I want to welcome our witnesses. Thank you for the important input you've had and the advice read through your papers. Very, very helpful. This is a thorny issue, and as someone who's an advocate on behalf of federal employees, this was a shocker. I do understand the real issues behind this, though. I've had some experience sitting as a trustee on pension funds where we assumed years ago that would always have, our target rate was 7 or 8% interest on our funds, and actuarially we could sort of stay within those guidelines, and we could provide defined benefit pensions to people, and we could project that out. Now we're in an interest rate period where it's half that, and so, Mr. Dowdy, is that the core issue for you here in terms of you're trying to project over a very long period of time? I know your experience rating is different. The expectations on long-term morbidity and all of that, but the fact that you can't, if you're putting this money in the market and getting a return on your investment, and it's so low, even over a long period of time, you cannot pay the benefits. Is that the crux of the problem?
That is one of the major issues with the program. Not the only one. I think some of the other issues were raised around people living longer, being on claim longer, all of that kind of experience. But investment expectations have significantly changed because of the prolonged low interest rate environment, and that represents a very significant portion of the problem. Absolutely.
I notice, unlike John Hancock, a lot of other insurers have just got out of the business. They've exited. I think in the majority memo, they said there were 100 companies doing this business not too long ago, and now they're down to 12 that are doing individual policies and maybe a similar amount doing group policies. So it's not an area where people are flocking to it, and as I understand it, the federal contract that you've signed prevents you from getting any additional profit as a result of increasing the premiums. Is that correct?
Yes, that's correct, but we were quite happy to do that. I mean,
well, I'm sure you weren't happy, but
well, no, but one of the reasons you referenced all the people that have left the industry, and why is that? Because we've talked already about the need is going up.
Right.
The truth is, it's a very difficult business to be in. John Hancock has been around for 150 years. We're very proud of our brand. Nobody likes to raise the price on customers, and I think that's been a big challenge. So it's made it very difficult for people to stay in the business.
I understand.
But we negotiated not to make any additional fee off of the fact that we had to raise rates on these.
Let me thank you for that. I understand you came forward, your company came forward and agreed to that. I think that at least eliminates the possibility that, that there's gouging going on or anything like that, since you're not getting any additional profit by raising the premiums. But it doesn't help my constituents, the federal employees who have to pay these premiums. And I hear the stories of Mr. Thyssen, and puts a human face on this. Let me just shift, Mr. Cohen. Thank you so much. I love UMass Boston. They wouldn't let me in, but I jog around the back of it along the water there. I actually did take a few courses there before I went to law school, so I appreciate it. Let me ask you, Mr. Connolly raised the issue of flood insurance. It's intriguing. And to encourage more, there are some key differences here, but to encourage more insurers to get into this line of business, would it be helpful to have a government backstop like we do in the flood insurance field, where we actually, by our subsidy, we do provide a lot of assistance to families who would otherwise not be able to afford flood insurance?
Well, I mean, there are different ways to think about it. One is that you could imagine either the state or the federal government organizing a pool
Right.
among insurers where right now they have a premium tax that goes maybe to a guarantee fund, maybe it goes to a reinsurance backstop.
Yeah.
And they all agree to a set of principles in the way that they operate. And if either one company or whatever has losses above that, then that's spread across the companies.
Okay.
That's one way to think about it. You know, one thing that I wanted to make sure that got out there, and that is that when you look at, for example, people who are on claim, you know, it is true that right now, even 22 years of premium payments would be made up in about 5-6 months of actual long-term care expenses. And so I have to say that even in the presence of rate increases, that means it's closer to 8 months. If you turn out to be one of the people who become disabled for a significant amount of time, meaning 2 to 3 years, you're getting a lot of benefit out of your policy. And I just want to make sure that that's understood here.
Well, that's a good point. Thank you. Mr. Chairman, I know I've exhausted my time. I yield back.
Thank the gentleman for yielding. Now recognize the gentlelady from Virginia for her 5 minutes.
Thank you, Chairman, and I thank the committee for holding this hearing. You know, when my constituents, and because I'm in Virginia and have many federal employees also, were notified by OPM in July of these large premium increases, they were understandably concerned, and we certainly did hear a lot from them, and that's why I had joined folks in requesting the hearing, so I appreciate you all being here and taking a look at this issue. Walt Francis, a health economist and an expert on these programs, was quoted in the Washington Post as saying, quote, "This never should have happened. The long-term care estimates should have been actuarially sound and accurate, taking into account far more carefully both the possibility of low interest rates, the low rate of return on premiums invested in bonds, and thirdly, the adverse selection by persons most likely to need long-term care." Could Mr. Dowdy and Mr. O'Brien really address the interest rate assumptions that were here, as well as just the general statement, and maybe some others would like to join also, but why don't we start?
Maybe I can start. Certainly, referencing the quote, which I'm not that familiar with, but you know, looking back, we clearly got it wrong, and there's no question about that. And it's creating a big issue, as you reference, for your constituents. The question is, could you have done better? And what we do know is that our actuaries used the information we've talked about. This is a relatively new product. Experience is emerging. They use the best, they're trained to use the best estimates that they can at the time, set the best assumptions that they can at the time. And we weren't alone in doing that. You know, we vetted those with outside actuarial firms. OPM used their experts to look at them, and I know used outside actuarial firms. So it is a very challenging question, and specifically on the interest rate one, that is a big driver. You know, as small as someone mentioned earlier, a relatively small change in your long-term projection around interest rates can have a significant impact when you're assuming that to you know, you're losing that revenue year after year after year.
But I think you've addressed it a little here, but would the premium increases shorten the contract period if it went from like 7 to 3 years? Would that help? Is that something that OPM that you're looking at, or would?
Honestly, we do not think that shortening the contract period from, sorry about that. Honestly, we don't think that shortening the contract period from 7 to 3 years, we can make adjustments during the contract periods if we desire to. So a shorter contract period does not necessarily solve any problem.
I would like to jump in here and say that, you know, when the product was first priced, it was new. It was a new product, so you had to look at other things, like population data, because there was no insured data, and you had to look at other products. I'll give an analogy. It's that time of year, college football. If you think about the preseason top 10 football polls, it's based on last year's teams. You don't really know. You're trying to project this year. Now that we're almost to December, you have a lot more information, and that top 10 has changed. It's kind of a similar situation here. So we have a lot better data now. Another thing to remember is the product was priced as a guaranteed renewable product, meaning that premium rates can be reset. If it had been priced as a product with level premiums that couldn't change, the initial prices would have been a lot higher to start with.
One other point on that with respect to these actuarial assumptions, part of the challenge that the whole industry has faced is the issue of waiting until you get what you perceive to be credible experience. And so that means that if you've waited 10 years and all of a sudden you're now certain because you have all of this credible experience, you've got about 10 years back to make up. And I think one of the ways that we could improve the functioning of this market is to have insurers certify on an annual basis based on what actual assumptions are operating in the marketplace. For example, you see what's happening with interest rates. You know that. You don't have to wait 5 years to know that this year you're earning 1% or so on. And so we just completed a study and asked a question about that, and overwhelmingly, people would prefer, if there have to be rate increases, people would prefer more frequent, smaller increases, similar to health insurance, than infrequent, large, one-time hits.
Okay. Mr. Thiessen, did you want to comment at all? I'm sorry. Okay, I see my time is about to expire, so thank you.
I think the gentlelady, we're getting back. We'll now recognize the gentleman from Virginia, Mr. Breyer.
Great. Thank you, Mr. Chairman. Thanks for allowing me to sit on the hearing today. This is something that affects many of my constituents. I think I have more federal employees and federal retirees than any other member of Congress. And believe me, we have heard from them. The phone rang off the hook. And they're
wait a minute. I'm not sure about that.
These are a
Barbara
meaningful
and I might
competition.
compete with that.
Mr. Ranking Member, thank you for requesting this hearing. For example, Rebecca Cuddy shared the story of her mother and unaffordable premiums. Sharon Reynolds wrote about how she feels completely entrapped with the unaffordable premiums. Jim Reel asked many effective probing questions. And I sent several letters to OPM requesting an explanation and a justification for why this is happening, what we can do to fix it, and at least how to plan to prevent this from ever happening again. So Mr. O'Brien, maybe Mr. Doughty, why during the interim actuarial reviews didn't you know that a premium hike was imminent and at least make this information available to the current enrollees? One of the big problems they had was sticker shock after 7 years. Or why not even perhaps interim rate increases at the 4 or 6 year period?
That's an excellent question, and I'd like to kind of go through the timeline. What we had found at the end of the last contract cycle, there were two sets of hard facts we had to deal with. First, when we got the funded status report in June of 2014, was when the reevaluation of the long-term cost projections by John Hancock indicated that the long-term costs of the program were higher than we were originally projected. Then, in April, as part of the contract, when they provided us with bids, they had done additional revisions of their assumptions, including revisions to their long-term projection of revenue returns. So we had, as I've said in my testimony, we had the confluence of two unfortunate factors. We had higher long-term projected costs, and we had lower long-term projected returns. So those two facts meant that we had a very huge increase coming on. We then had a decision we could make. We could have made a decision where you could have phased in the increases over several years, but we knew what the magnitude of those increases were going to be. So Mr. Cohen has made the thing that people would rather have more frequent, smaller increases, but I would put that in context, given the magnitude of the bad facts that we had to deal with. It's different to say, yes, give me smaller increases, rather than give me 30% this year and then follow it up with a 40% next year. Because then you have the situation in long-term care that people can make the 30% increase, and they stretch to make their budget, but they can't make the 40% increase. So they're in a circumstance where we have effectively made them pay additional money for a benefit they will not be able to take advantage of because they make the choice to lapse.
And Mr. Bryan, I think you go right to the heart of this, too, because what I heard from so many people was they signed up in 2002 or sometime along the way with really expectations and guarantees that this was the premium as long as their benefits. In fact, in the 2002 literature, I quote, "Premiums have been set to remain constant for life unless you increase benefits." And then in the renewal in 2007, I think you said that somewhere along the way that they signed a form indicating premiums may only increase if I'm among a group of whose premium is determined to be inadequate. And basically, no one saw that. In fact, the literature, the only thing that's different in the literature from 2002 to 2009 was you left out that line about premiums set to remain constant. Here, we're always guarding against binding arbitration hidden in the 6-point type on the back of the contract. What did you do proactively to make sure that people knew in 2009 that they could really get hit the next time around?
Well, we were criticized in hearings in 2009, and we took those criticisms to heart, exactly the points you were making, Congressman. Since 2009, the materials that are shared with enrollees have extensive information about the fact that premiums can increase. In fact, people positively attested that they are aware of that. I'm happy to share with you in detail the information of how we've changed the materials and what information we now provide people since 2009 to clarify the possibility that their premiums will increase. If we can improve on that and make it even clearer, we are happy to do so, but we think we made extensive changes to the materials to make that clear.
Well, I confess, if you talk to the people that you serve, they don't feel that way. Mr. Thisson, you had suggested perhaps a federal long-term care insurance oversight board. Is that still a good idea?
Well, I think that there should be a public-private partnership. Oops, I'm sorry. I think there should be a public-private partnership that looks at catastrophic protection and looks at ways to encourage more individuals to purchase long-term care insurance, because the wider we can spread the risk and the wider we can spread the pool, it helps everybody. And then I also think that if we can put something together like that, we possibly maybe even can save some money on Medicaid because we've paid some of that up front.
Okay, thank you. Mr. Chairman, thank you. I yield back.
I thank the gentleman. We now recognize for additional round the gentlelady from Virginia.
I just had one more question, but what % of policyholders, I'm sorry if I missed it, have dropped their policies since this increase this summer, and what % cut back on their coverage in some way?
Roughly 3% of policyholders chose to drop coverage, so that they took the contingent non-forfeiture option. Of the 172,000 people who made a decision during the decision period, roughly a little over half, or 93,000 of those, took the option whereby they reduced their benefit to keep their premium the same.
And could you, what exactly was the reduced benefit?
There were various options in terms of how you could reduce the benefit to keep the premium the same, so wasn't a one-size-fits-all.
But half of them reduced their benefits so that they could keep?
Yes.
Okay, thank you.
Thank you, lady. Now recognize Mr. Connolly, the ranking member.
I thank the Chair. Mr. O'Brien, I ran out of time in questioning you, but if I understood your response to my last question to you, it was that OPM has given no thought to recommendations for how to resolve this issue, address the issue, ameliorate the issue. You gave consideration to, in response to Mr. Byers' questions, parceling out the premium increases and decided against it because you didn't think that would be particularly helpful. But what about, I mean, we're listening to suggestions from NARF and from Professor Cohen about some creative ways we could go about trying to address this problem and make it easier for Federal employees, Federal retirees to access this product. I want to give you the opportunity to respond, because is it really your testimony on the record that OPM hasn't given a thought to that.
I believe what I said is that we've given thought.
Please move that closer to you.
Oh, sorry.
Thank you.
Okay. I believe what I'm saying is that we do not have a position that I can offer in terms of recommendations to this committee as far as what we think we should do to move forward in terms of addressing the problems in long-term care insurance. I have found this hearing very, very helpful. There's a number of ideas and proposals and ways to deal with the challenges of the program, and we are wide open to working with this committee and all of these individuals on how we can come up with solutions.
But Mr. O'Brien, it's not my purpose to play Torquemada here, but surely you knew about this hearing. You knew we were planning on this hearing. This is not a new item in the press. It's gotten lots of coverage. You certainly have had feedback from Federal employees and Federal retirees. We certainly have, Ms. Comstock, Mr. Breyer, and myself. And yet you come here empty-handed. You're open to ideas. The hearing is fascinating, but we have nothing in our kit bag to offer the people we serve. That's your testimony.
My testimony is that we do not have a proposal that is ready for being shared with the committee at this time. The options and the discussion that has been offered around here goes in a number of different directions. We would like to evaluate those possibilities and come to this committee and this group with a proposal that we could really lay out, and we've weighed all the pros and cons, and we have not yet done that.
Any idea of the timeline when you will do that?
We are continuing to work. I cannot give you a timeline at this time, sir.
Well, then let me say this to you. I'm the ranking member of the subcommittee, and I'm going to use every influence I've got to make sure you are summoned back to this subcommittee. And at that point, we will expect specific proposals. You owe that to the Federal employees and retirees who count on this product. You're not a passive observer who just responds to the whims of the market with, oh my. You have an obligation to the people you serve. And you have an obligation to this Congress to come here with concrete ideas about how to ameliorate and resolve this issue. And we will expect that next time we see you, sir. I yield back.
Gentleman yields back. Does the gentleman from Wisconsin have any questions?
Yeah, sure. First of all, a comment. I think any company could bid on this product, correct?
Yes.
How many different companies in the country offer long-term care insurance? Dozens?
I think about a dozen has been stated at this meeting.
About a dozen. Okay. So one would think that if somebody could offer this plan for less, they'd be given a contract in the future, and we'd solve the problem. I think there's some underlying problems here with long-term care insurance that I'd go into, and my guess is, well, I'll ask one question, then I'll go on my soapbox again. If premiums for long-term care insurance gone up in general across the board, like if I go to my individual insurance agent or anything, is this a industry-wide phenomena?
Yes, I think it's safe to say that almost every insurance company offering long-term care has faced the need to raise premiums.
I thought so, and I think if any congressman thinks you're doing a lousy job of running their company, they can apply to be the chief executive officer of any long-term care insurance company and make a boatload of money for you guys if they can think a better job than the free market can do. But back to the last question. It is nationwide, if I just go to my local insurance agent, how much can I expect my premiums to go up, say, every year for the last 5 years? You think about.
I think it varies greatly, similar to this program, depending on the type of product that you've bought. But our, and I'll just speak to John Hancock on the private insurance, the retail insurance that we've offered, and generally speaking, it's gone up by the same factors and similar amounts over time.
And that's true of your 11 competitors too, about?
Fairly similar, yes.
I would assume John Hancock, I would assume you guys know something about trying to offer insurance at the lowest price, don't you? And if you didn't, wouldn't one of your competitors undercut you and put you out of business?
Yes.
That's kind of something that everybody who graduates from high school should know by now, wouldn't you think?
I mean, I would think that one of the realities that the industry faces is that insurance, the cost of insurance as they go up have been going up. The same factors have been applying to all companies. And
You guys have been surprised the amount of claims compared to where you all thought it was going to be 10 years ago, right? That's the underlying problem.
That's correct. The amount of claims and the investment environment that we talked about earlier.
Right. And as long as people maybe continue to live longer, be more likely to have diseases, Alzheimer's or whatever, that you have to put people in long-term care, premiums are going to have to go up, no matter how much a politician wants to grandstand and be critical of you, right?
Premiums will go up as claims go up and the need and cost of long-term care goes up. That's absolutely right. We should, someone pointed out earlier, as this is a relatively young product, and we started with very little experience. So as we gather additional data, we should be able to get better, but not perfect, at predicting what those costs would be.
And if I yell at you some more and ask you to reduce your costs, is that going to make any difference at all as long as more and more people continue to need long-term care? No matter how much I yell at you, no matter how many times I bring you back in this room?
Well, in terms of the federal program in John Hancock, we obviously have an obligation to make sure that there's sufficient prices being charged to make sure that those claims can get paid in the future.
Right. It's not going to matter. I can't yell at you and say, keep coming back here until you lower your costs, as long as more people need the insurance, right? I mean, need a payout, right? I'm sorry for what you're having to put up with here. I guess that's it.
There are some countervailing trends, which advances in healthcare, for example.
Probably keeping people alive a little longer too, right?
Right.
Yeah.
But it may turn out that we're keeping people alive longer with less disability. I mean, that's part of the uncertainty here is frankly, it can go in both directions.
It can, but largely the industry is hostage to the number of people who need long-term care, which they can't control, right?
I agree that they can't control the number who need long-term care. I don't know if they're held hostage to that, but.
Well, assuming they're not going to go through bankruptcy, they're hostage to it. But, okay, thanks much.
Gentleman yields back. The chair recognizes the gentleman from Virginia.
Thank you, Mr. Chairman, very much. Mr. Doughty, one of the things that I've been confused about, I did sign up for long-term care insurance. And when I got the notices, I show that my premium, which was $325 a month, went to $483. And I got the 3 different options, which seemed perfectly fair. But the letters that we were getting in our office were from people 10 years older than I, who'd signed up for premiums at $180, $150, and $200 that were up to $1,200. That were up by factors of 4, 5, 6. And I'm trying to figure out, why was there such a difference in the increase in the premiums person to person? I felt like I got a relatively soft landing compared to the letters that I was receiving from constituents who probably had much less ability to pay than I did.
So there definitely were differences in the amount of increase depending on things like age, the type of benefit that you owned, et cetera. But I would be very interested in following up after you, because the maximum increase that was required was 126%. So I think there must be some confusion around, you know, if people think their rates are going up by 5 or 6 times. And I would love to work with those constituents directly, if we can, to make sure that we're giving them adequate information to make sure we understand exactly what choices they're making.
Because the clear unaffordability was what came home so hard to them. The other deal, too, is feeling cheated, that they put in money for year after year after year, and then all of a sudden it becomes unaffordable, and they have a choice of taking a much smaller premium that wouldn't cover their, or getting all their money back, which doesn't do them much good at age 75 or 82. So, Mr. O'Brien, just one, as a retailer of 40-plus years, we generally like to increase our labor rates like $1 at a time and hope people don't notice it, rather than do it all at once and double it, or 126%. Might take that in consideration going forward.
Would I had that option, it would have been great.
Yeah. I know Mr. Connolly was was very firm there at the end. And I think what I heard from that is that we really need a commitment from you to have to do things differently, lest the 2016 hearing be like the 2009 hearing. And we're back here again in 2023, tearing our hair out again and asking you questions that you have a hard time answering.
I would like to avoid that as well.
And on the notion of why we couldn't have made, I'm still not convinced that the actuarial things. You talked about the perfect storm, the low interest rates. Well, we've known we've had low interest rates since the Great Recession, or that people were living longer. We've known that for a long time, too. Was it only April of this year that we suddenly realized how off balance we were? How out of sync we were with the premiums?
Again, what we had is we had first a reevaluation by John Hancock in terms of their long-term cost projections, which we learned about in June of 2014. And that was when we knew that there were going to need to be rate increases, but those were the higher costs. Then later, as there were continued refinements to the assumption, including the revisions to the long-term investment returns, we got the new premium rates in April of 2015. And that's when we had the situation where we had 83% average rate increases that we rolled out. It's a fair discussion about whether or not you would have done that incrementally, did one increase and followed by the other increase, and which would have been the least pain. The decision we made, which was, and the risk we thought we ran once we knew that there was going to be substantial rate increases needed over the period to keep the experience fund solvent into the future, which is our primary responsibility, is that if we had done it in what were going to be large increments, no matter what we did, increments of 20 and 30% over several years, we thought we ran the risk of essentially having people stretch to stay in the program, and then a year later, when they got the next increase, be unable to do it. And they would have been paying an additional year's premium that they could not afford and have gotten no benefit from it. What we decided, and it's fair to say there are other decisions that were possible, was to do the entire increase at this point based on the best information we have to take the fund, on the best information we have into the future and provide these opportunities for landing spots, of opportunities to maintain the current premium, cut your benefit a little and pay a little bit more premium, or keep the same premium if that's all you could afford. That was the decision we made, and I still feel it was the correct one.
Okay, great. Thank you. Mr. Chair, I yield back.
Gentleman yields back. Seeing no other questions, I'd like to thank our witnesses for taking the time to appear before us today. If there's no further business without objection, the subcommittee stands adjourned.
Thank you, Ken.
Thank you. Good job. Good to see you. And the car worked well, too.
Oh, good.
Yeah.
Keep in touch with us.
I'm happy to